Someone asked me something about a comment a few weeks back. I answered half of it in my last video. They wanted to know if I ever stopped believing in one of my ETFs, would I just leave it alone and start buying something new? Or would I actually sell it? Welcome back to another episode of Almost Wealthy. I show you real numbers behind my buy, borrow, die portfolio, no filters. So I went back through a few videos I ever made about my holdings to answer this honestly. To answer the question, I have never sold one of my core ETFs, not even once. That's not me dodging the question, that's the actual answer. And today I want to show you exactly why and the rule for the day that changes. Back in March, SCHG sold Cisco. They sold AbbVie, one of their biggest position. They also cut all of the energy stocks, and it bought United Health Group, a stock that was down 48% from its high. And when I first saw that, it looked like a fund falling apart. Here's the part that matters. It didn't do any of that. SCHG isn't run by a person picking stocks. It tracks an index, the Dow Jones US Dividend 100, and that index reruns a formula every March. Whatever the formula is, the fund does. 25 stocks went in, 22 stocks came out. Cisco, AbbVie, Ballard, Halliburton, all gone because the dividend yield had dropped relative to better options after the price run-ups. United Health came in down 48%, and now it's SCHG's second largest holding. Not because the index thinks the regulatory drama around United Health is overblown, because a 48% price drop on dividends that keep growing made the yield look like a more attractive buy on paper. I still own SCHG the exact same way I did before March. Here's why the index made those specific moves, because it wasn't random. Like I said, SCHG tracks the Dow Jones US Dividend 100 index. Every stock has to raise its dividends for 10 straight years just to be considered. There are 4 screen ranks that's left: the cash flow versus debt, return on equity, dividend yield, and 5 years of dividend growth rate. Top 100 scores in, everyone else gets out. Ballard Energy had rallied about 80% while it was in this fund. While the stock price runs hard, its dividend drops relative to the price, and its score dropped with it. That's why energy got cut across the board. The sector rallied so hard, it's priced itself out of the top 100. United Health Group is the opposite. Down 48% means the yield on that same dividend is much higher relative to the price. If the company is still raising their dividend and the cash flow is still strong, a 40% price drop can actually push the stock score up, not down. That's the part most people miss about this fund. The formula doesn't care about the headline. It only cares about the math. And here's the number that actually matters to me as a holder. The stocks that got added have an average 5-year growth rate of 63%. The stock that got removed had an average of 37%. The whole fund growth rate moved from 8.63% to 9.38% because of this one reconstruction. My SGHD position is $1,695.93, and it raised its quarterly distribution to 0.2569 a share, back-to-back increases. That's the fund doing exactly what I bought it to do. This is the distinction I wanted you to walk away with. A fund doing its own internal housekeeping based on a public formula it's followed for years is not the same thing as me deciding to sell an ETF. This already happened to your account too, whether you like it or not. The time I held through a bad stretch. Around the same time SCHG was losing to the S&P 500. SCHG was up 4.18% on the year. The S&P was up 8.03%. My growth fund got lapped by the broad market, and my first thought was, should I be worried? There were pretty much 3 things that were stacking at once when it came to SCHG. The rest of the market finally caught up to the tech, so the S&P looked stronger by comparison. There was also a Chinese AI company called DeepSeek that spooked the market, and NVIDIA was 12% of SCHG, and it fell almost 17% in one single day. Also, you had the tariff fear that hit Apple, Microsoft, NVIDIA directly, and those all 3 alone make up 30% of the fund. So SCHG had pretty much a rough few months. I looked at the long-term numbers instead of the short-term ones. 5 years annual return, SCHG at 15.89% and the S&P at 13.82%. 10 years, SCHG at 18.86% and the S&P at 15.5%. SCHG beat the S&P by over 3 points a year, every year for a decade, and a rough month didn't erase that. Here's what that 3 points a year turns into. If you take 10,000 invested over 10 years ago at SCHG 18.86% annual return, that's roughly 56,300 today. And if you take those same numbers with S&P at 15.5%, that's 42,300 today. That's almost a $14,000 gap from the same starting number, and it gets wider the longer you hold. SCHG isn't coming from a speculative basket. 59 billion in assets, 196 in holding, and the expense ratio is 0.04%. Basically, you own it for free. The top 5 holdings is NVIDIA, Apple, Microsoft, and Alphabet. Almost 40% of the fund is exactly why it swings harder than the S&P in both directions. That concentration is what made it lag for a few months. It's also what made it beat the S&P by 3 points a year for a decade. Both of those are the same fund. It didn't sell a share. I didn't reduce what I was buying. I just kept going. There's a second reason why I didn't touch it, specific to how I use SCHG. SCHG sits in my grow collateral slice, which means its whole job is appreciation in value. So I have more to borrow against. More collateral means more borrowing power. More borrowing power means more bills I can move off my paycheck onto the loan. So selling SCHG during a rough stretch wouldn't just lock in a bad quarter. It will shrink the exact asset the rest of my strategy depends on. Most investors judge a fund year to year, sometimes quarter to quarter. When it lags, they get antsy and start looking at whatever ran last. That instinct is exactly how people end up buying high and selling low over and over. My time horizon isn't in quarters or even in years, it's decades. I don't need SCHG to win in a 3-month stretch. I need it to be bigger in 10 to 20, 30 years than it is today. If you actually look at the history, growth stocks don't lag forever. 2022 was brutal for growth. In 2023 and 2024, growth had dominated everything. Then this rough patch, the patterns repeat, and every investor who captures that 18.86% 10-year return lived through every one of those rough patches. Sitting still was the strategy the entire time. So have I ever sold an ETF? Put those two together, and here's the honest answer. No, not when one of my funds had a bad quarter. 0 ETFs sold the whole time I've been building on this portfolio. That's not because I'm stubborn. It's because neither of those situations was actually a reason to sell. One was routine maintenance happening inside a fund I still believe in. The other was normal short-term noise on a fund that's still beating a benchmark over the long run. Selling on either of those would have been a reaction, not a decision. Why selling is a bigger deal for me than most investors. Here's the part that makes that question matter more in my strategy than a normal portfolio. The buy, borrow, die only works if the die part actually happens, meaning I hold these assets until I pass them on until I cash them out. There's a tax rule called step-up basis. If I sold SCHG until I die, my heirs inherit it at whatever it's worth that day. All the gains in between just disappear for tax purposes. If they sell it then, they owe nothing on the growth. But that only works if I never sold it myself. The second I sell an ETF I've held for years, I turn decades to unrealized gains, untaxable growth into a taxable event right now at whatever taxable gain rate it is that year that I sell. That's real money gone permanently the moment I hit the sell. So for me, selling isn't just did the price go down? It's, am I willing to trade the entire tax advantage this strategy is built on for this specific reason? The bar is high on purpose. Compare that to the normal investor with the normal brokerage account. If they sell a stock they've had for years and take a loss, that loss can even offset other gains at that tax time. There's flexibility built into that system. My system doesn't have the same flexibility because the entire point of holding is to never trigger the taxable event in the first place. Every time I even consider selling, I'm not just weighing, is this still a good fund? I'm weighing that against giving up decades of tax-free compounding on whatever I sell? That's a much bigger question that most people are asking when they think about selling an ETF. My actual rule. Here's the framework in order. Step 1, redirect new money first. If I start losing confidence in a fund, the first move is to never sell. It's simple. Stop buying more of it. New deposits flow somewhere else. What's already sitting there stays exactly where it is, still compounding, still doing its job. Step 2, only actually sell if the thesis is broken. Not because I had a bad quarter, not because the S&P beat the fund for a few months. The thesis breaks when something structural changes. The fund changes what it tracks, the expense ratio spikes, or the fund simply stops doing the job I bought it for. SCHG's job is growth and collateral. SCHD's job is dividend growth. SPYI, VYMI, and GPIQ is income. If one of them stop being able to do the specific job, not underperforming for a while, but structurally can't do the job anymore, that's a real reason. A rough quarter is not a reason. Step 3, if I do sell, I will say on this channel with the real tax costs included. No pretending it's free because it's the right call. Selling breaks the never sell mechanism this whole strategy is built on, and I'm not going to hide that as a trade-off if it ever happens. Let me go back to the original question because it actually had 2 parts and I want to answer both of them. Would I leave it alone and start buying something else instead? Yes, that's step 1 and is a far more likely outcome. Would I actually sell the position outright? Only at step 2 and only if the thesis is genuinely broken, not just bruised. Those are 2 different moves with 2 very different costs. Leaving a position alone costs me nothing. The shares keeps compounding, keeps paying dividends, keeps doing whatever it needs to do. Selling costs me a tax bill right now on however many years of gains I've built up. That's why step 1 absorbs almost every situation I can realistically imagine, and step 3 barely ever gets used. Since I started this portfolio back in March, step 3 has never once been the right call. What would actually break this thesis? Let me make step 2 concrete so this isn't just a theory. If SCHG expense ratio jumped from 0.04 to something like 0.50, that's a structural change. If SPYI or GPIQ change how they generate income, say they drop the option strategy that makes them work, that's a fund that no longer is doing its job. If a fund got delisted, merged into something else, or the issue reconstructed it entirely, that's another real reason. None of these have happened as of yet. What doesn't count is a bad 6 month, a scary headline, losing to the S&P on a stretch. Those are things that already happened to my portfolio, and I held through them all. Where is my portfolio now? $11,052.29 is what my portfolio is worth now. Every fund in this is the same fund I bought from day one. No swaps, no exits. My blended yield across all of them is 5.23%. I've only got $343.54 borrowed against it right now, about a 3.11% loan on value. Still well ahead of my 5.65% borrowing rate with room to spare. That's the actual track record behind the rule I just gave you. Nothing hypothetical. 5 funds, 1 strategy, 0 exits the whole way through. Now let's wrap this up. Would I ever sell? Yes. If the thesis actually breaks. Have I ever sold? No, not once, not yet. And an index doing its own reconstruction isn't selling for me, or a rough quarter. The bar is a structural change to the job that the fund is supposed to do. And until that happens, redirecting new money is as far as it goes. That's the whole rule. In the order I actually use it. If you ever sold an ETF you regret selling or held one that you probably should have let go, let me know in the comments. I read everything. If you want to see what I actually do the day my thesis breaks, subscribe. I'll show you exactly that with real numbers and when that happens. I post these updates every week. So 0 ETFs sold, 1 clear rule for the day that changes, and the strategy that only works if I actually stick to it. Thank you for watching, and I will see you on the next one.